In today's video, we're going to be answering a question from a subscriber. He says would be interested in more detail on how you generate your Monte Carlo simulation. And then will you make this kind of simulation available as a service? To answer the last question, yes, that actually is available. I'll tell you more at the end of the video. But first, let's get into the specifics of how you do a Monte Carlo valuation simulation, or at least how I try to do it. And one stock that has been in the headlines a lot lately, not just lately, but for a long time, is Nvidia. So after the DeepSeek news came out and hit the stock price a little bit, is Nvidia currently trading at a good value? I thought this would be a good example to look at. So we're going to take a look at that stock within the context of the Monte Carlo valuation model. So anytime you're trying to value a stock, the ultimate objective is you're trying to decide or figure out what is Nvidia's price going to be in the next 10 years, or at least that's kind of my goal. I'm a coffee can investor, meaning that I hold stocks for at least a 10-year period, if not longer. So I'm really trying to estimate a reasonable fair value out that long. And to know this, all you need are basically two bits of information. How much are the earnings per share going to be in the next 10 years? And then what are the multiples that investors are going to be willing to pay for Nvidia out 10 years? And if we just know both of these things, then we can know what Nvidia's price will be in 10 years. The problem, of course, is that knowing either, let alone both of these metrics, is basically impossible. But we can come up with some educated guesses. And the simplest way to make a first estimate is to go with the historical numbers. So here we have Nvidia's historical sales per share, and on the right we have owners' earnings per share. This is basically Warren Buffett's calculation of free cash flow. But if we look at the compound annual growth rate, which I've got calculated here, over the last 5 years, Nvidia has grown its sales per share at 62%. This is annually, which is insane. They've grown over the last 10 years, 40% per year, and then we've got 10-year standard deviation of 40%. We'll get into more of that in just a second. If we look over here to the right, the numbers are even more impressive. 5-year compound annual growth of owners' earnings, or free cash flow, is 85%. 10-year is 54%. So in predicting 10-year earnings, we could just say, let's start with the current earnings of $2.47. And let's say that those grow at the lowest growth number that we see here, which is this 40% number on 10-year sales per share. So we can compound that out. It's 2.47 multiplied by 1 plus, in this case, 40%, so 0.4. And we're going to take that to the 10th power for 10 years. And that gives us $71.45. The problem, of course, with this scenario is that it's assuming Nvidia is able to replicate its past growth. And as we know, that does not happen very often. Sometimes it's even better than it has been. Other times it's worse. We just don't always know exactly what it's going to be. There is a scenario in the future, a possible scenario, where Nvidia's sales start to slow. We saw this in 2008. You can see their sales per share actually declined, or basically stagnated, for the next 5 years. So it's possible that Nvidia's sales start to taper off here, or if DeepSeek threat does come true, they could even start to fall. We could see similar things happen with margins and therefore earnings. If Nvidia's sales start to slow and competition starts to erode their pricing power, we're likely to see the earnings actually decline. Or it's also possible that the earnings could continue to grow at this extremely fast rate for as long as the eye can see. And that's where Monte Carlo analysis can be extremely helpful for our question here of what will earnings be in 10 years. What we can do is basically give the computer a set of statistical parameters around the 40% growth rate. So let's say we think Nvidia can grow at 40% per year, but over time, that is likely to slow down to a more reasonable 10% growth rate. We've seen this with companies Historically, you've seen it with Apple. Their growth rate is extremely high, but eventually, as market saturation picks up and competition also increases, that growth rate will naturally slow towards 10%. But in Nvidia's case, we know there's also a very wide range of potential outcomes. It's possible that their earnings may grow at like 80% in a year. It's also possible that earnings may grow at 0%, or it's even possible that they could grow faster than that, maybe 120%, or they could even drop by 40%. So there's a lot of potential outcomes that Nvidia could experience in the future. That's where this standard deviation comes into play. The historical growth rate standard deviation for Nvidia has been 40%, and that's where I got these numbers. So we could expect in any given year, Nvidia is likely to grow somewhere between 80% and 0%. And in a really extreme year, they could grow 120% earnings, or they could shrink 40% earnings. And this could happen from year to year to year to year, all over the place. There's so many possible things that could happen along the way. So in the Monte Carlo simulation, what we're doing is we're saying, okay, computer, let's do 100,000 simulations where you take these parameters, 40% growth dropping down to 10, and then you're going to randomly assign an annual growth rate each and every year that fits within these statistical parameters. And that is going to come up with an extremely different outcome in 10 years. In some cases, you're going to have numbers way bigger than 7145. In others, you're going to end up with numbers way smaller than 71. And then the final question is on multiples. If the earnings per share indeed come in at 71.45, Nvidia's stock price depends significantly on what multiple it might be trading at. So to figure out what multiple is reasonable, we can take a look at this chart, which shows us the historical valuation multiples for Nvidia. I've got different metrics here: price to sales, price to free cash flow, price to earnings, EV to EBIT, and the one I'm going to focus on here, which is owner's earnings. Over the last 10 years, they've traded at a low of 14.8 owner's earnings. They've traded at an average of 52, call it 53, and a high of 128. So let's go back here and say these examples, let's round 14.8 to 15. The average will say 52, and then at the higher end, we'll say 120. And let's make this 50 just for easy figuring. So at the low end, Nvidia would trade for about $1,050. At the average, they'd trade at $3,500. And then at the high end, they would trade at about $8,500. And the current stock price is around $130. So all of these scenarios would be extremely bullish, even if they traded at a low price to earnings multiple. However, remember that this assumed a 40% annual growth rate, which is most likely in the more optimistic range. But the point is that not only do the earnings, which we don't know what they're going to be, but the multiple that they're trading at is also extremely wide in its potential outcomes. So just like I did with earnings in the Monte Carlo simulator, I told the computer to calculate the standard deviation of its historical price to earnings ratios. And then each 10-year period, when you randomly assign what the earnings will be, you take that earnings per share and you also assign that based on a randomly distributed price to earnings ratio somewhere around an average of 50, with a low end at 15 and a high end at 120. In all cases, I limited the ending to no more than a 50 times multiple. I don't think it's wise to make a valuation estimate based on a higher multiple than that. Even that might be a bit of a stretch. And when we do this for Nvidia, this is what we get. So what we've got here is the number of times of these 100,000 simulations that the stock price landed in this particular range. So one, we have 0 here, basically bankruptcy. So there were very few simulations where Nvidia actually went bankrupt after 10 years, which I know seems absolutely ridiculous. It's not very likely. As you can tell, there's not too many bars that are like that, but it is possible. But then on the other end, you also have extremely optimistic scenarios. Looks like you have one here where the ending stock price was $20,000. You've got a couple here that were over $15,000, and you've got several that are, extreme outliers to the right. But the majority of simulations occur here. And up here on the top right chart, we can see what those are. So in the bearish outcome, The 10th percentile, so in this case, earnings were really bad and the multiple probably was lower than expected. That one, the stock price ended at $48. So over 10 years, you lost 9.1% annually. The 25th percentile, which would be number 75,000 out of 100, that was a 3.7% compound annual growth rate, with the stock price ending at $179. And then the most likely scenario based on our simulation was a stock price of $484, which represented a 14.5% compound annual growth rate. And then you have the extremely bullish outcomes, which is where Nvidia goes up 25% annually or 34% annually. And those are all based on the current stock price of $125. So if I'm an investor and I'm looking at Nvidia right here, I would say it looks to me like my possible outcomes are very much skewed to the right. I'm pretty comfortable with a 14.5% compound annual growth rate. I think that would be an outstanding result. But even if it's a 25th percentile result, I think that's okay. I would be fine earning, something close to a low-end treasury bond over the next 10 years. And then in some extremely rare situations, maybe you're going to lose most of your investment, half of your investment, or something like that. But I feel confident that the potential rewards in this simulation far outweigh the cons. But I do recognize that all of these are well within the realm of possibility, which is why this type of valuation is so powerful. Rather than just coming up with some straight line estimate where you think earnings are going to grow at 40% and nothing bad's going to happen, this opens your eyes to the possibility that things will be far different than what you thought. So you can build in what Benjamin Graham called the margin of safety. And as for the last question of will I make these available as a service, I'm excited to announce that these Monte Carlo simulations are available for every single stock in the S&P 500 to all Patreon and YouTube members. So if you're a Patreon subscriber or a YouTube subscriber, you'll have access to all of these charts for the S&P 500. I'll also be making the Dow Jones 30 available for free on Patreon. So if you go over to Patreon, sign up as a free member, you'll get access to the Dow Jones 30 if you want to check these out. So all of those scorecards will be available starting today, February 1st. Also announcing, again, we're going to be doing a live stream just like we did last month on February 10th, 2025 at 2 p.m. Eastern Time. We're going to be doing a member-only live stream. So if you want to jump on, ask questions, or just hang out, I'd love to have you there. It's going to be on Google Meet. If you'd like to sign up for that to get the charts and also for the live streams, you'll also get access to 2 courses. We've got a How to Value Stocks course and a Financial Freedom Formula course. Both of those combined for be about 8 hours of content, 100 different videos. We've got Excel templates, PDF templates, all of that. I think this is a phenomenal value, honestly. I think if you sign up, you're going to get a lot more than, $10 a month out of it, which is what it's priced at currently. So yeah, sign up if you want to. Obviously, do whatever you want, do whatever your budget allows. But I think it's a pretty fair price for all that you get. So hopefully I'll see you over there. Appreciate all of you who have signed up so far. Appreciate your support in helping me run this channel and continue to make quality content for YouTube. So thanks to everyone for watching, and I will see you in the next video.